You're sitting at the kitchen table with your partner. Tax season just ended, and you're staring at a number that makes absolutely no sense. You both got raises this year. You both maxed your retirement contributions. You did everything the financial gurus tell you to do. And somehow, you owe the IRS $4,300. Meanwhile, your coworker who makes exactly what you make, married to someone who makes exactly what your spouse makes, got a refund of $2,800. Same income, same household. Completely opposite outcome. You're looking at a $6,000 swing based on one single factor. And that factor isn't how hard you work or how smart you are with money. It's a quirk in the tax code that nobody warned you about when you were planning that wedding. Welcome to the marriage tax penalty, where the government charges you extra for the crime of saying "I do." Except here's where it gets even more confusing. For some couples, marriage is the best financial decision they'll ever make. The IRS literally pays them to get married. And the difference between getting penalized and getting rewarded has nothing to do with love or commitment. It's pure mathematics. And most couples have no idea which side of that line they're standing on until it's too late. My name is Alex, and I've spent the last 8 years reverse engineering tax strategies that wealthy people use while everybody else fumbles through TurboTax hoping for the best. And what I'm about to show you is something that changes everything about how you should think about household finances the moment you get married, or even before. If you're planning your financial future with a partner and you want to know whether marriage will cost you thousands or save you thousands, make sure to hit that subscribe button and give this video a thumbs up if learning the actual math behind major life decisions sounds valuable to you. Because today we're going to break down exactly when marriage creates a tax penalty, when it creates a bonus, and the specific moves you need to make immediately to position your household for maximum wealth regardless of which category you fall into. Here's what most people believe about taxes in marriage. You get married, you file jointly, you combine your incomes, and the government treats you fairly based on your total household earnings. That sounds reasonable, right? Two people working together, building a life together, taxed as a single economic unit. Except that's not how it actually works, because the tax brackets for married couples filing jointly aren't simply double the brackets for single filers. They're close in some places and wildly different in others. And that difference creates situations where two people earning $50,000 each will pay more tax as a married couple than they would as two single people. The system literally charges them extra for being married. Now, here's what makes this even more frustrating. The marriage penalty doesn't hit everyone equally. It specifically targets certain types of couples while rewarding others. And the factor that determines which group you're in has nothing to do with your total household income and everything to do with how that income is distributed between the two of you. Let me paint you a picture of how this plays out in real life. Meet Sarah and Jordan. They both work in tech. They both earn $90,000 per year. Total household income is $180,000. They're doing well, not rich, but comfortable. They get married. Beautiful ceremony. Honeymoon in Portugal. Life is good. Then April rolls around. They sit down to file their taxes together for the first time, and they discover they're paying about $2,000 more in federal income tax than they would have paid as two single people. Same jobs, same income, same deductions. But now they're married, and the IRS wants an extra $2,000. That's the marriage penalty in action. Now let me show you the flip side. Meet Marcus. He's a dentist earning $200,000 per year. His wife Rachel is a stay-at-home parent managing their household and raising their two kids. She has zero earned income. Total household income is still $200,000, higher than Sarah and Jordan. But when Marcus and Rachel file jointly, they save approximately $10,000 per year compared to what Marcus would pay as a single filer. The IRS is essentially paying them $10,000 per year to be married. Same institution of marriage, completely opposite financial outcome. So what's the difference? Why does one couple get penalized while the other gets rewarded? It all comes down to income distribution. When two people earn similar amounts, the marriage penalty kicks in hard. When one person earns significantly more than the other, or when only one person earns income, marriage creates a massive tax bonus. The wider the income gap between spouses, the bigger the bonus. The closer their incomes are to each other, the more likely they'll face a penalty. And here's the thing that nobody tells you when you're planning a wedding. This isn't a small quirk that affects a few $100s. For high-earning dual-income couples, the marriage penalty can cost $5,000, $8,000, even $12,000 per year. That's real money. That's a vacation. That's a car payment. That's a significant chunk of your retirement contributions just evaporating because you decided to get legally married. Now I know what you're thinking. This sounds unfair. It is unfair, but here's what matters more than fairness: understanding exactly how this works so you can navigate around it. Because there are legitimate strategies that can minimize the penalty or maximize the bonus depending on your situation. But before we get to those strategies, you need to understand the three core mechanisms that create this penalty in the first place. First mechanism is bracket compression. For single filers in 2024, the 22% tax bracket starts at $44,726 and goes up to $95,375. That's a range of about $50,600. For married couples filing jointly, the 22% bracket starts at $89,075 and goes up to $190,750. That's a range of about $101,600. Now notice something. That's not double the single filer range. It's not even close. It's double at the bottom but compressed at the top. So if you have two people each earning $80,000, they're both solidly in the 22% bracket as single filers. But when they get married, a big chunk of their combined income gets pushed into the 24% bracket. That extra 2% on $50,000 or $60,000 of income adds up fast. Second mechanism is the phase-out cliff. Certain tax benefits, like the ability to deduct student loan interest or contribute to a Roth IRA, start phasing out at specific income levels. For single filers, the Roth IRA contribution starts phasing out at $146,000. For married couples filing jointly, it phases out at $230,000. Again, not double. Two single people could each earn $130,000 and both still contribute fully to Roth IRAs. Combined household income of $260,000. But if they get married, their Roth IRA contribution gets completely eliminated at $240,000. They lose access to one of the best wealth building tools available just because they signed a marriage certificate. Third mechanism is deduction limitations. The standard deduction for a single person in 2024 is $14,600. For a married couple filing jointly, it's $29,200. Hey look, that one actually is double. Finally something fair. Except, it's not really a bonus, it's just neutral. And here's the problem. Many itemized deductions like state and local tax deductions have caps that don't double for married couples. The SALT deduction cap is $10,000 whether you're single or married. So two single people could each deduct $10,000 in state and local taxes for a combined $20,000. But once they're married, they're capped at $10,000 total. They just lost $10,000 of deductions. If they're in the 32% bracket, that cap just cost them $3,200 in extra federal tax. Let me give you the actual numbers for a couple of scenarios so you can see exactly how dramatic this gets. Scenario 1. Both partners earn $75,000 each. Total household income $150,000. As single filers, each person's federal income tax is about $12,000. Combined tax burden $24,000. As a married couple filing jointly with the same income, their federal income tax is about $26,300. Marriage penalty is $2,300 per year. Over a 30-year marriage, that's $69,000 in extra taxes just because they got married. And that's not even accounting for what that $69,000 could have grown to if they'd invested it instead. Scenario 2. One partner earns $160,000. Other partner earns $30,000. Total household income $190,000. As single filers, the higher earner pays about $31,000 in federal tax. The lower earner pays about $2,400. Combined tax burden $33,400. As a married couple filing jointly, their federal income tax is about $28,000. Marriage bonus is $5,400 per year. Same total household income as scenario 1, actually higher. But because the income is unevenly distributed, they get a bonus instead of a penalty. Over 30 years, that's $162,000 in tax savings just from being married. And if they invest those savings, that number gets even bigger. Now here's where it gets really interesting. The marriage penalty isn't just about income tax brackets. It hits you in other ways that most people never consider. Take the Affordable Care Act subsidies. If you're single and earning $50,000 per year, you might qualify for significant healthcare subsidies. If your partner is also single earning $50,000, they might also qualify. But combine those incomes through marriage, and suddenly you're at a $100,000 household income and your subsidies disappear. I've seen couples lose $4,000 to $6,000 per year in healthcare subsidies just because they got married. Add that to the bracket penalty, and you're looking at a total marriage penalty of $8,000 to $10,000 per year. That's brutal. Or consider the student loan interest deduction. Single filers can deduct up to $2,500 in student loan interest if their income is below $75,000. Married couples filing jointly can also deduct up to $2,500, but only if their combined income is below $160,000. Notice the problem. Two single people could each earn $74,000 and each deduct their student loan interest. Combined household income $148,000. But once married, if their combined income hits $160,000 or more, they lose the entire deduction. That's another $1,000 in extra tax. Now stay with me here, because this next part is where most people make their biggest mistake. They discover they're facing a marriage penalty, and they think the solution is to file separately instead of jointly. Let me tell you why that almost never works. When you're married filing separately, you lose access to a massive list of tax benefits. You can't take the earned income credit. You can't take the child and dependent care credit. You can't take the education credits. You can't deduct student loan interest at all. You can't contribute to a Roth IRA in most cases. Your capital loss deduction gets cut in half. If one spouse itemizes deductions, the other spouse must also itemize even if the standard deduction would be better. The list goes on and on. The IRS has specifically designed the married filing separately status to be punitive. They want to discourage it. And they've succeeded. In almost every scenario I've analyzed, couples who file separately end up paying more total tax than if they'd just filed jointly and eaten the marriage penalty. There are rare exceptions involving income-driven student loan repayment plans, but for the vast majority of couples, filing separately is financial self-sabotage. So if filing separately doesn't work, what do you do? How do you actually navigate this? Let me walk you through the strategies that actually matter. Strategy 1 is timing your marriage strategically. I'm not suggesting you delay true love for tax purposes, but if you're already planning to get married and you have flexibility on timing, the date matters. Here's why. If you get married on December 31st, you're considered married for the entire tax year. If you wait one day and get married on January 1st, you file as single for the entire previous year. For couples facing a marriage penalty, getting married in January instead of December can save thousands of dollars. You get one more year of single filing status, one more year of separate Roth IRA contribution limits, one more year of individual deduction caps. It's the same relationship, the same commitment, just with better tax timing. I've seen couples save $5,000 to $7,000 just by pushing their wedding date from late December to early January. Strategy 2 is maximizing retirement contributions immediately. This is huge and almost nobody does it. When you get married, your ability to contribute to retirement accounts changes based on household income. If one spouse doesn't work or earns very little, they can now contribute to a spousal IRA even with no earned income of their own. That's an extra $7,000 per year that can go into tax-advantaged retirement accounts. For high-income couples facing the marriage penalty, maxing out every possible retirement contribution becomes critical. 401k contributions, health savings account contributions, backdoor Roth conversions. Every dollar you can shift into tax-advantaged accounts reduces your taxable income and chips away at that penalty. I've seen couples reduce a $5,000 marriage penalty down to $2,000 just by restructuring their retirement contributions in year 1 of marriage. Strategy 3 is rebalancing your income sources if possible. This is the nuclear option, and it's not available to everyone. But if you have flexibility in how you earn income, you can sometimes restructure to create a more uneven income distribution between spouses. For example, if you both run small businesses or have side income, you might shift more revenue to one spouse's business and have the other spouse draw a smaller salary. Or if one spouse has investment income, you might restructure asset ownership to create more separation. The goal is to make your household income look less like two equal earners and more like one primary earner with a secondary income. Again, this isn't possible for everyone. If you both have W-2 jobs, you can't just magically shift your salary. But for couples with business income, rental income, or investment income, this kind of restructuring can turn a marriage penalty into a marriage bonus. Strategy 4 is geographic arbitrage combined with marriage timing. This one is advanced but powerful. Some states have their own marriage penalties or bonuses on top of the federal system. California, for instance, has its own bracket compression issues. If you're a high-earning dual-income couple living in a high-tax state, your marriage penalty can be $15,000 to $20,000 per year when you combine federal and state. But if one spouse can establish residency in a no-income tax state like Florida, Texas, or Nevada before marriage, you create opportunities for tax optimization. I'm not suggesting tax fraud. I'm talking about legitimate residency changes that some couples can make if their work allows remote flexibility. Strategy 5 is the one nobody wants to hear, but I'm going to say it anyway. Sometimes the math says don't get legally married, stay in a committed relationship. Have a ceremony if you want, share your lives completely, but skip the legal marriage certificate. I know that sounds unromantic, I know it goes against cultural expectations, but for some high-earning dual-income couples, the marriage penalty is so severe that avoiding legal marriage saves them $10,000 to $15,000 per year. Over a lifetime, that's $500,000 or more. Now you lose some legal protections by not being legally married. You need to set up powers of attorney, healthcare directives, and beneficiary designations to protect each other. But those documents cost a few $100s to set up. If you're facing a $10,000 per year marriage penalty, you break even in 2 weeks. I've worked with multiple couples who did the math and decided legal marriage wasn't worth the cost. They're still together, still committed, still building wealth as a household. They just refuse to pay the government an extra $200,000 over 20 years for the privilege of filing jointly. Now let's talk about the marriage bonus side of this equation, because if you're in that category, you need to maximize it immediately. If you're in a household where one person earns significantly more than the other, getting legally married should be a top financial priority. The tax savings are real and substantial. I'm talking about $8,000 to $15,000 per year in many cases. But here's what most couples in this situation miss. They get the bonus automatically just by filing jointly, but they don't optimize around it. They don't restructure their financial life to squeeze every possible dollar out of that bonus. Let me show you how to do that. First move is to maximize the lower earner's retirement contributions. If one spouse earns $30,000 and the other earns $150,000, the lower earner should max out their 401k contributions, even if it means their take-home pay drops significantly. Why? Because the household can absorb it. The higher earner's income covers living expenses. And every dollar the lower earner contributes to retirement reduces household taxable income at the higher earner's marginal rate. You're getting a 24% or 32% tax deduction on contributions funded by someone in a 12% bracket. That's tax arbitrage. That's free money. Second move is income shifting through business ownership. If the higher earner runs a business or has self-employment income, hire the lower earning spouse. Pay them a legitimate market rate salary for actual work performed. This shifts income from the higher bracket to the lower bracket within the household. The business gets a deduction. The spouse receiving the salary pays tax at their lower rate. The net household tax burden drops. You need to follow all employment laws and pay a reasonable wage for actual services. But if done correctly, this move can save thousands per year. Third move is strategic asset location. This is where couples with a marriage bonus have a massive advantage. You can put income-producing assets like dividend stocks, bonds, and real estate in the lower earner's name. The investment income gets taxed at their lower rate. Meanwhile, growth assets like index funds that don't generate much annual income can stay in the higher earner's name. Over decades, this asset location strategy can save tens of thousands in taxes. But it only works when you have a large income gap between spouses. Dual high earners don't get this benefit. The real magic happens in your brain. Because this isn't just about tax brackets and deductions, it's about fundamentally rethinking how you approach household wealth when you get married. Most couples merge their finances emotionally but keep thinking about money as individuals. They still calculate their personal salary, their personal net worth, their personal retirement accounts. That's the trap right there. Once you're married from a tax perspective, you're not two individuals. You're one economic unit. And the IRS treats you that way whether you like it or not, so you need to start thinking that way too. Here's what that means practically. Stop thinking about whose paycheck covers which expense. Stop thinking about splitting things 50-50. Stop thinking about individual account balances. Start thinking about total household income, total household expenses, total household net worth, and total household tax burden. When you make financial decisions as one unit instead of two individuals who happen to be married, everything changes. Suddenly it becomes obvious that the lower earner should max their retirement contributions, even if the higher earner pays all the bills. Suddenly it becomes obvious that you should optimize around the household marginal tax rate, not individual income. Suddenly it becomes obvious that asset location and income shifting aren't complicated strategies, they're just basic math. But here's where most couples struggle. Money is emotional. Money is tied to identity and power and independence, especially in relationships where one person earns significantly more than the other. The higher earner might feel entitled to more decision-making power. The lower earner might feel vulnerable or dependent. These are real psychological dynamics, and they can prevent couples from making optimal financial decisions. I've seen couples facing a $10,000 marriage bonus who refuse to restructure their finances to capture it because it would require the lower earner to reduce their take-home pay, even though the household would be better off. Even though the money is fungible, they can't get past the emotional dynamic. That's leaving money on the table because of psychology, not mathematics. Let me be blunt about something that makes people uncomfortable. In households with large income disparities, the financially optimal strategy often involves the lower earner essentially becoming financially invisible from a tax and income perspective. Maxing retirement contributions, minimizing taxable income, shifting assets to their name but managed jointly, operating as a financial ghost who exists to optimize the household tax position. That's uncomfortable to say out loud. It feels like it erases the lower earner's contribution or independence. But here's the thing. If both partners fully commit to household wealth maximization, that lower earner's reduced take-home pay and tax-optimized structure can generate $15,000 to $25,000 per year in household tax savings. Over a career, that's $1 million or more. That contribution is massive, even if it's invisible on a W-2. Now let me show you how this plays out over a lifetime, because the marriage penalty or bonus isn't just a single-year event. It compounds. Let's go back to our two scenarios. Sarah and Jordan with their $2,300 annual marriage penalty. If they stay married for 30 years and invest that penalty instead of paying it, assuming an 8% return, they're giving up about $260,000. That's their penalty. Not $2,300, $260,000 in lost wealth. Marcus and Rachel with their $10,000 annual marriage bonus. If they invest those savings for 30 years at 8% return, they accumulate over $1.1 million in extra wealth just from their marriage bonus. Same institution of marriage. $1,360,000 difference in outcomes? That's why this matters. That's why you can't just ignore it and hope it works out. The difference between optimizing around your marriage penalty or bonus and just letting it happen is enough to fund your retirement or not. It's enough to send your kids to college or not. It's enough to retire 10 years early or work until you're 70. This is real money. Life-changing money. And most couples never even calculate whether they're facing a penalty or bonus, let alone optimize around it. Here's what you need to do right now. First, calculate your actual position. Are you facing a penalty or getting a bonus? Use tax software or work with a CPA to run the numbers both ways. Calculate your tax as married filing jointly. Then calculate what your combined tax would be if you were both single. The difference is your penalty or bonus. You need to know that number. Second, if you're facing a penalty, immediately maximize every tax-advantaged account you have access to. 401k, HSA, traditional IRA, anything that reduces your taxable income. Every dollar you can shield from taxation chips away at that penalty. Third, if you're getting a bonus, restructure your finances to maximize it. Income shifting, asset location, spousal retirement contributions, all of it. Capture every dollar of that bonus and invest it. Fourth, model out the long-term impact. Take your annual penalty or bonus, multiply it by the number of years until retirement, and calculate what that money would grow to if invested. That number should terrify you or excite you enough to take action. And here's the controversial move. If you're engaged and you run the numbers and you're facing a massive marriage penalty, have a real conversation about whether legal marriage makes financial sense. I'm not telling you what to do. I'm telling you to make an informed decision with full knowledge of what it costs. Some couples will decide the legal benefits and social recognition are worth $10,000 per year. Other couples will decide they'd rather keep that money and skip the legal ceremony. Both decisions are valid as long as you're making them consciously, not by default. Your household wealth isn't determined by your individual salaries. It's determined by your combined after-tax income and what you do with it. The marriage penalty or bonus is one of the biggest factors in that equation, and it's one of the most ignored. Don't be the couple that discovers they've been paying an extra $8,000 per year for 10 years and never noticed. Don't be the couple that could have captured a $15,000 annual bonus but left it on the table because you never restructured your finances after getting married. This is your money, your future, your retirement. The government has already set the rules. You can't change the rules. But you can absolutely play the game better than 98% of married couples who never even realize there's a game being played. Run your numbers. Know your position. Optimize ruthlessly. Your future self who's sitting on an extra $500,000 or more will thank you for it.